Wealth building isn't always as glamorous as it seems. The glitz and glamour of wealth building often portrayed in the media can give us a distorted perception of what it truly means to accumulate wealth. We see stories of overnight millionaires, but rarely do we hear about the long-term strategies and consistent efforts that underpin most successful wealth-building journeys. At its core, wealth building is about understanding the fundamentals, making smart decisions, and sticking to a plan. It's not about making a quick buck or chasing the latest investment fad. It's about adopting what some might call boring strategies that, while they might not make headlines, have proven to be effective over time. Financial literacy is the cornerstone of these strategies. It's about understanding basic concepts like budgeting, saving, and compound interest. These concepts might seem simple, but they form the foundation for wealth accumulation. By mastering these fundamentals, you can make informed decisions about your money and set yourself on the path to financial success. Next comes the world of investments. Stocks, bonds, index funds, real estate. There's a whole universe of investment options out there. But navigating this universe requires understanding the importance of diversification and risk management. Building a robust investment portfolio isn't just about picking winners, it's about creating a balanced mix of investments that can weather market fluctuations. And let's not forget the power of compounding. Compound interest, the concept of earning interest on your interest, is a powerful tool in wealth accumulation. It rewards those who start early and let their investments grow over several years. It's not about getting rich quick, it's about getting rich slowly, steadily, and surely. But perhaps the most important aspect of wealth building is the mindset. It requires a long-term perspective, the ability to avoid impulsive decisions, and the discipline to stay the course during market ups and downs. Patience and persistence are key. Wealth building isn't always glamorous, but with the right strategies and mindset, it can be incredibly rewarding. Let's debunk the myth and take a closer look at how you can build wealth in a more sustainable and realistic manner. Understanding money is the first step towards building wealth. Now you may ask, what's so complex about money? I earn, I spend. Well, that's just the tip of the iceberg. Understanding how money works is the foundation of financial literacy. Let's start with budgeting. Imagine your money as a pie. Each slice represents a different expense in your life. Some slices are bigger, like rent or mortgage payments. Budgeting is about understanding the size of these slices and ensuring that your income can cover them all. It's about making sure you don't run out of pie before you've fed all your expenses. Next comes saving. Think of it as a slice of the pie that you set aside for your future self. It's a slice you don't eat now but save for later, maybe for a rainy day, a dream vacation, or your retirement. The trick is to consistently set aside a piece of your income, no matter how small, and resist the temptation to spend it. Finally, we have compound interest, the secret sauce that turns your savings into a wealth-building machine. Imagine you plant a small seed, your savings, in the soil, a savings account or investment. Over time, this seed grows into a tree, sprouting more seeds, interest. These new seeds fall into the soil, sprouting their own trees. Before you know it, you have a whole forest grown from that one initial seed. That's compound interest in action. It's the process by which your money makes more money over time. So there you have it, the basics of financial literacy. Budgeting to manage your money, saving to protect your future, and compound interest to grow your wealth. It might sound simple, but mastering these concepts can be a game changer. It's like learning to read and write for your finances, and remember, even the most successful investors started with these basics. Mastering these basic financial concepts is the key to unlocking your financial potential. You're not just spending and earning anymore. You're planning, saving, and growing. You're on your way to becoming a financial whiz, and who knows, maybe even a millionaire by 2024. Investing is not just for the rich. Everyone can do it, and here's how. Now, you might be wondering, where do I start? There are so many options available, it can be overwhelming. But don't worry, we're here to simplify it for you. Let's start with the basics. There are several types of investments suitable for beginners. First up, we have stocks. When you buy a company's stock, you're buying a piece of that company, becoming a part owner. If the company does well, so do you. But remember, the opposite is also true. Next, we have bonds. Think of bonds as IOUs. When you buy a bond, you're lending money to a company or government. In return, they promise to pay you back with interest. Bonds are generally considered safer than stocks, but their returns can be lower. Then there are index funds. These are a type of mutual fund or exchange-traded fund that aim to mimic the performance of a specific index like the S&P 500. They offer a way to invest in a wide array of companies with a single purchase, which can be a great way to diversify. And let's not forget about real estate. Buying property can be a solid investment. You can earn income through renting it out and potentially benefit from appreciation over time. Now here's a crucial point. No matter what you choose to invest in, diversification is key. It's like having eggs in different baskets. If one basket falls, not all your eggs are broken. Diversification can reduce risk by spreading your investments across different types of assets. So, where do you go from here? Start by researching these options. Understand what suits your financial goals and risk tolerance. Then, take that first step. Remember, the sooner you start, the more time your investments have to grow. Diversifying your investments can reduce risk and increase your chances of achieving your financial goals. This might seem a bit boring, but trust me, it's these boring strategies that can lead you to millionaire status by 2024. Compound interest is a powerful tool in wealth accumulation. It's like a snowball rolling down a hill, growing larger and faster with every revolution. But how does it work? Let's break it down. Imagine you have $100. You invest it and earn a 10% return. After a year, you have $110. Now here's where the magic happens. The next year, you're not just earning interest on your original $100. You're earning interest on the whole $110. That's compound interest. It might not seem like much at first, but over time it adds up. Let's take the example of two individuals, Alice and Bob. Alice starts investing $1,000 a year at age 20, while Bob starts investing the same amount at age 30. By the time they're both 60, Alice, who started 10 years earlier, ends up with nearly twice as much money as Bob, even though she only invested $10,000 more. That's the power of compounding at work. Now you might be thinking, but I don't have $1,000 to invest right now. That's okay. The point is not the amount you start with, but the habit you develop. Even a small amount invested regularly can grow substantially over time. Here's another example. Say you can only afford to invest $50 a month. Over 40 years, with a 7% annual return, you'd end up with over $200,000. And remember, that's just $50 a month. Compound interest is often overlooked because its power isn't immediately obvious. It requires patience and consistency, but once you understand it, you'll see why Albert Einstein reportedly called it the eighth wonder of the world. So don't wait. Start investing now, even if it's a small amount. Increase it whenever you can. Stay consistent. And most importantly, be patient. Let your money work for you. Let it grow. Start early, invest regularly, and let the magic of compounding do its work. It's not a get-rich-quick scheme. It's a get-rich-slowly, but surely, strategy. And it's one of the most reliable ways to build wealth over the long term. Patience is a virtue, especially when it comes to investing. Let's delve into why a long-term mindset is so crucial in the world of investing. The financial world is often portrayed as a fast-paced, high-stakes environment where fortunes are made and lost in the blink of an eye. While such scenarios do occur, they are far from the norm and certainly not the path most millionaires take. In reality, wealth accumulation is a slow, steady process, like the growth of a mighty oak from a tiny acorn. A long-term mindset in investing means understanding that success comes from consistent efforts over an extended period. It's about resisting the urge to chase quick profits and instead focusing on stable, sustainable growth. Think of it this way, investing is akin to planting a garden. You can't expect a seed to sprout into a full-grown plant overnight. It takes time, care, and patience. Similarly, your investments need time to grow. Discipline plays a key role here. It's easy to panic when the market takes a dip or to get carried away when it's on the rise. But just like the tortoise in the famous fable, slow and steady wins the race. Staying disciplined means sticking to your investment plan, even when things get rocky. Patience, too, is vital. The benefits of investments are often not immediate. They accumulate over years, even decades. It's important to resist the urge to withdraw investments at the first sign of profit. Instead, let them sit, let them grow. The power of compounding, which we discussed earlier, works best when given time. So, if you're dreaming of becoming a millionaire by 2024, remember to think long-term. Cultivate patience and discipline, avoid impulsive decisions and stay the course, even when the market fluctuates. Embrace the boring but effective strategies that have proven successful for countless investors. Remember, wealth building is a marathon, not a sprint. It's a journey that requires endurance, resilience, and a clear vision for the future. So keep your eyes on the prize and your feet steadily moving forward. Now, let's explore some boring but proven strategies for wealth accumulation. Like a tortoise in a race, they might not be flashy, but they're steady, and they get the job done. First up, we have dollar cost averaging. This strategy involves investing a fixed amount of money at regular intervals, regardless of the market price. Over time, this approach can mitigate the impact of market volatility, allowing you to accumulate more shares when prices are low and fewer when prices are high. It's like setting your financial journey on cruise control, letting you ride out market highs and lows with relative ease. Next on our list is investing in low-cost index funds. Index funds are a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track a market index. These funds offer broad market exposure, low operating expenses, and low portfolio turnover. They're like a slow-cooked meal, minimal fuss for maximum flavor. Over time, the returns from these funds can compound into substantial wealth. Lastly, we have automating savings. This strategy is all about making your money work for you without you even realizing it. By setting up automatic transfers to your savings or investment account, you're paying yourself first. It's like having a silent partner working in the background, steadily building your wealth. These strategies might seem dull compared to the thrill of day trading or investing in the latest hot stock, but don't be fooled by their lack of glamour. They're like the unsung heroes of wealth building, quietly working in the background, steadily building your fortune. The beauty of these strategies lies in their simplicity and effectiveness. They don't require a finance degree or hours spent watching the stock market. All they require is a commitment to consistent action over time. So, while they might not make for exciting dinner party conversation, these boring strategies are your secret weapon for building wealth. They're the tortoise in a world of hares, steadily and reliably moving towards the finish line. These boring strategies might not be exciting, but they're proven to work. And remember, in the long run, it's not about getting rich quick. It's about getting rich, period. Controlling expenses and managing debt effectively are crucial to accelerating wealth accumulation. In this maze of financial journey, it's easy to get lost in the allure of spending and accumulating debt. But remember, the key to building wealth isn't just about making more money, it's also about how well you manage what you have. Let's start with controlling expenses. It's not about depriving yourself of life's pleasures, but rather about making conscious decisions. Prioritize needs over wants. For instance, do you really need that latest smartphone model, or is your current one still serving you well? Create a budget and stick to it. This will give you a clear picture of where your money is going and where you can cut back. Next up is managing debt. It's not uncommon to have some form of debt, be it student loans, credit cards, or mortgages. The trick is to not let it spiral out of control. Always pay your bills on time to avoid late fees and a higher interest rate. If you have multiple debts, consider strategies like the snowball method, where you pay off the smallest debt first while making minimum payments on the rest, or the avalanche method, where you tackle the highest interest debt first. Keeping a frugal lifestyle can also help you speed up your journey to financial freedom. This doesn't mean living a life of deprivation, rather it's about making smarter choices that can save you money. For example, cooking at home instead of eating out frequently, or choosing to buy quality items that last longer instead of cheaper ones that need to be replaced frequently. Lastly, it's important to build an emergency fund. This is your financial safety net in case of unexpected expenses or loss of income. Aim to save at least 3 to 6 months worth of living expenses. In the grand scheme of things, these may seem like small steps, but they can make a big difference in your financial health. By controlling your expenses, managing your debt effectively, and living a frugal lifestyle, you're not just saving money. You're also investing in your future. Remember, every dollar saved is a dollar earned. Risk is a part of investing, but it can be managed. This is the first truth every budding millionaire must embrace. So, let's dive into some key strategies that will help you navigate the unpredictable waters of investment. First up is diversification. It's the old wisdom of not putting all your eggs in one basket. By spreading your investments across different asset classes like stocks, bonds, real estate, and even commodities, you reduce the risk of losing everything should one investment go sour. It's like a safety net, catching you when one tightrope snaps. Next, we have asset allocation. This is about finding the perfect blend of different assets in your portfolio, based on your risk tolerance and investment horizon. If you're young and have a higher risk tolerance, you might lean more towards stocks. But if you're nearing retirement, bonds might be more your speed. The key is to strike a balance that suits your personal situation. Now let's talk about an emergency fund. This is a stash of money set aside to cover unexpected expenses or financial emergencies. It's your financial lifeboat, ready to spring into action when the seas get rough. Having an emergency fund not only provides peace of mind but also prevents you from having to dip into your investment portfolio when life throws you a curveball. Now imagine these three strategies as the pillars of your financial fortress, each one supporting and reinforcing the others. Diversification spreads your risk, asset allocation aligns your investments with your goals, and an emergency fund safeguards your financial stability. Together they create a robust defense against the uncertainties of the financial world. But remember, risk management isn't about eliminating risk entirely. That's impossible. Instead, it's about understanding the risks, preparing for them, and mitigating their potential impact. It's about making smart decisions that protect your wealth and set you on the path to becoming a millionaire by 2024. Effective risk management can ensure your financial stability even in uncertain times. So, adopt these strategies, stay disciplined, and watch your wealth grow. Investing isn't a set-it-and-forget-it thing. You've probably heard this phrase before, and it's true. Investing is a dynamic process that requires regular monitoring and adjustment. You can't just put your money into an investment and then completely neglect it. It's like planting a tree. You can't just sow the seed and then never water it. You need to tend to it, nurture it, and make changes when necessary to ensure its healthy growth. Monitoring your investments is essential for a number of reasons. First, it allows you to track your progress towards your financial goals. Are your investments growing as expected? Are you on track to become a millionaire by 2024? Regular monitoring provides the answers to these questions. Second, it enables you to spot any potential issues early. If one of your investments is consistently underperforming, it might be time to consider whether it still fits into your financial plan. Remember, it's okay to let go of investments that aren't working out. It's all part of the process. Third, it helps you stay informed about changes in the market. The financial world is always evolving, and staying on top of these changes is crucial for making informed investment decisions. For instance, if there's a major shift in the economy, you might need to adjust your investment strategy accordingly. But how often should you monitor your investments? Well, there's no one-size-fits-all answer to this. It depends on your individual circumstances and investment strategy. However, a good rule of thumb is to review your portfolio at least once a quarter. This allows you to stay informed without obsessing over every minor market fluctuation. Adjusting your investment strategy is equally important. As you progress on your financial journey, your goals and circumstances might change. Maybe you're planning to buy a house, start a family, or retire early. These life events might require you to adjust your investment strategy to ensure it aligns with your changing needs and goals. In conclusion, monitoring and adjusting your investment strategy is a crucial part of the wealth-building process. It's not the most glamorous part of investing, but it's one that cannot be overlooked. Stay informed, stay flexible, and you'll be in a good position to achieve your financial goals. Let's recap what we've learned today. We've debunked the myth that wealth building is all about glamour and quick wins. Instead, it's about mastering the basics of financial literacy, understanding concepts like budgeting, saving, and the power of compound interest. We've dived into the world of investments, exploring options like stocks, bonds, index funds, and real estate, and emphasized the importance of diversification and risk management. We've also discovered the magic of compounding, how it can multiply your wealth over time, and why starting early makes all the difference. We've talked about the significance of a long-term mindset, the patience to weather market fluctuations, and the discipline to avoid impulsive decisions. We've discussed how boring strategies like dollar-cost averaging, investing in low-cost index funds, and automating savings have been utilized successfully by many to build wealth over time. We've stressed the need to minimize expenses, avoid unnecessary debt, and live frugally to accelerate wealth accumulation. We've also highlighted the importance of risk management strategies like asset allocation, diversification, and having an emergency fund to mitigate potential losses and ensure financial stability. Finally, we've touched on the need to regularly monitor your investment portfolio and adjust your strategies based on changing market conditions and personal financial goals. So, what's the bottom line here? Boring strategies have the potential to make even beginners millionaires by the year 2024. It's not about chasing the next big thing or getting rich quick. It's about consistent, disciplined, and informed actions over time. It's about understanding the power of compound interest, diversifying your investments, managing risks, and maintaining a long-term perspective. These strategies might seem mundane or even boring, but they are the tried and true methods that have built wealth for countless individuals. And they can do the same for you. Remember, wealth building might be boring, but the results are anything but.